There are a number of things to consider towards the end of the tax year with regards to pensions, but I always think leaving it until the end of the year creates much more of a headache. So it's good to get a head start with regards to pensions planning at the beginning of the tax year by getting at least some of a base level of contributions in place on a regular basis if you can. This can help with pound cost averaging when investing, even if the bulk of the contributions are made at the end of the tax year in reality. However, for those looking to max out the contributions using all or some of any available carry forward, it can be really hard for you to get all the information together until very late in the tax year. So don't beat yourself up if you're still rushing around in March. That's perfectly normal. Collating data is half the challenge with regards to maxing out pensions. I usually start with what has been paid before. So we need to know the previous 3 years worth of pension contributions if we want to exceed this year's annual allowance, as well as the current tax year. If the annual allowance has been exceeded in any of the previous 3 years, you need to go back 3 more years from that one, and so on and so on. This is to determine what we have to play with. Of course, if you're remaining within the current annual allowance, there isn't such a pressing need for the extra information. It's important to understand the nature of contributions as well. Are they personal, net or gross? Are they salary sacrifice or pure employer? This is usually easiest to determine by looking at a payslip if it's not clear from the information provided by the pension scheme. Remember that the tapered annual allowance applied in previous years carry forward is only available up to the unused tapered amount, not the full unused standard annual allowance. Also, that unless we are talking about tapered annual allowance, previous earnings have no bearing on the amount of carry forward available. It's possible to have a full annual allowance to carry forward, even if they weren't working in that year, and even if they weren't even in the country. Don't forget, though, that not all income is equal when you're collating your information. For tax relief, we care about relevant UK earnings. That includes salary, self-employed income, benefits in kind. Basically, I like to think about this as active income, when you do something now to earn that income. It doesn't include things like passive income, such as income that is paid because of an asset, such as a rent from a property, pensions or dividends, or even interest from investments or deposits. However, both passive and active income are relevant when we are trying to calculate the adjusted and threshold income from the tapered annual allowance. It's also relevant when we are assessing the adjusted net income to determine if there is a loss of the personal allowance, if the high income child benefit tax charge applies, or if someone can claim tax-free childcare. Once we have all the information, then we're in a good place to determine the maximum level of contributions that could be made. I would always advocate using a calculator that takes account of all of the above, but I'm not a fan of the HMRC one for carry forward, as you can't save it or edit it. The reason you might want to do that is because I would always suggest 2 calculations, one showing the position of the current level of contributions if it's maintained, and one showing the position if the contributions you propose are made. This might sound like overkill, but extra pension contributions can reduce the threshold income and remove the client from detriment of tapering. Extra employer contributions will, however, increase adjusted income and therefore increase taper, so reducing the level of contributions that can be paid. Carrying out these 2 calculations means that you are less likely to make a mistake. You can't unwind pension contributions in many cases, and exceeding the annual allowance isn't an eligible reason. Although exceeding relevant UK earnings is, but it takes a little bit of time to claim back the excess. I would also suggest that you start collating the information as early as possible, especially with regards to previous year's contributions levels. So next time you have a new client or one that wants to maximise their contributions, then get into this data collection as soon as you can in the tax year. And the one drawing at the end, and this one is drawing to an end. No time to lose.